Hello and welcome to week 3 of investment management. We'll be talking about some trading stuff that I think is interesting, like what orders you can use in basic trades, how when orders transact, does it affect the prices, this type of thing. And I also want to extend what we were talking about last time a little bit with firms' decision to go public or their decisions to issue securities and how they do it. So recall that when firms go public, when they first issue public stock, that's not stock that just you and I can buy. There's a primary market, which are very large investors, that the underwriter, which is one big investment bank, the main investment bank that is helping the firm go public, the underwriter talks to these big investors to see what their interest is and to get an estimate for the value of the company and the price that the shares should be at. When we trade as retail investors, like we just log into our brokerage account and trade, we just trade amongst other investors. Very rarely do you actually trade against the company itself. Right? When you buy Apple, Apple doesn't get your money. Now there's a small exception to that, but this is largely the case. There's a lot more private firms in the US than public firms, by the way. A lot more. They're much smaller on average, of course. To be a private firm, you used to only be able to have 500 shareholders. Now, like 5 years ago or something, this changed, 6 years ago maybe, you can have up to 2,000 shareholders. And shareholders means an entity holding shares, not necessarily individual people. So if you have friends that you can form like a partnership with, let's say you have 6 friends or something that get together, and the partnership buys shares. Well, that's one shareholder, so you can kind of get around this rule. And I want you thinking about why firms might want to get around this rule. What are the advantages to going private? What's the advantages to going public? Think about that for a second, and we'll come back to that in a moment. Private firms raise money by either issuing private equity and finding individual investors that want them. This is usually like a direct search market. Right? They have to somehow find an individual that wants to buy this company, which people know very little about, so it's hard to do. Or private debt, which happens, probably about the same, I guess, I would say, but often done through banks, because these are much smaller companies and they can get loans or credit lines from banks, small business loans, these type of things. Now, private firms have much lower level of liquidity in their shares, but they do have fewer obligations with the financial statements they release each year. Really, as long as you're treating your employees okay, you're not fraudulent, and you're paying all of your taxes, you're probably going to be okay as a private firm. Okay, so this is the structure for the underwriting process. Get my fancy laser pointer out here. All right, there we go. We have the issuing firm. Let's say Facebook is IPOing. And then you have an underwriting syndicate, which backs the IPO and is in charge of taking it around and talking to big investors. The lead underwriter is the one that has the price risk for this IPO, which I'll tell you what that means in a moment. And then these private investors are going to be funds, very wealthy individuals, the people who can get in on the IPO on this ground floor. Now, when firms IPO, they can do something called a shelf registration, which is an additional to the shares that they're selling, the block of shares they're selling to the people in the primary market. They can kind of earmark a much smaller number of shares to hold at the firm that they can sell to the public in the secondary market. And this is where the firm is actually selling directly to us. This is the only case where when you buy shares of the firm, if you happen to trade with the firm, and I don't even think you necessarily know you would be trading with the firm, then the firm gets the cash and can use it to finance its operations and fund its operations. The vast majority of trades are not against the firm, though. This is a very rare exception. Now, a firm might do this when they need flexibility and the amount of capital, right? Like, let's say there might be expenses, but you don't know, or you think you'll have profits, but you're not sure how much, but you'll need a lot of cash. So after you IPO, you might include this just in case you need a little bit more money. Okay, so what do I mean by the underwriter bears the price risk associated with the placement of securities? This is what I mean. The underwriter, after shopping around and seeing what kind of interest there is for the firm and what the stock price of the firm could be, formally agrees, okay, we'll take the firm public and we will guarantee you this much money. So let's say we'll guarantee Facebook $50 a share. Well, if Facebook goes public for a lot more than that, then the IPO is going to sell Facebook, all these shares of Facebook, to these primary investors that want to buy it, let's say for like $70 a share, and make money doing that. Facebook gets the $50 per share that they were guaranteed, which they agreed to, and then the investment bank that is backing the IPO, that's underwriting it, gets a lot of the gap between the $50 to the $70, right? The $50 promised Facebook per share, and the $70 people ended up actually buying it for, which is its IPO price. Now, let's say they thought that Facebook would IPO for well over $50, and they promised Facebook $50. But for some reason, the environment shifts a lot, or I don't know, they did a bad job gathering info. And the large investors decide they don't really want to buy Facebook for that much. They want to buy it for like $30 or not really buy it at all. Well, the underwriter has guaranteed Facebook $50 a share. So the underwriter has to cough up that dough, and if instead the actual price is $30 a share, the underwriter is now losing $20 a share because they guaranteed Facebook $50. So that's what we mean when we say the underwriter bears the price risk associated with the placement of the new stock. Now, that said, IPOs are usually underpriced compared to what they could actually be sold at. This is done for a couple reasons. First, the underwriter needs to make some money, and firms going public know that. But there's another reason too, and that is there is a conflict of interest issue that gets mitigated if they promise the large private investors and hedge funds that help them price this security make a healthy profit. Here's an example. Let's say I was one of these wealthy investors and they came to me and they said, yo, we're going to take Facebook public, and you know a lot about Facebook. What's the most you'd be willing to buy Facebook at? And I said, well, the most I'd be willing to buy Facebook at is 60. It's worth 60 to me. I wouldn't pay over 60. And let's say a lot of other investors do that too. An investment bank says, okay, great. Well, we're gonna set this price at 60. The IPO price at 60. Well, that's annoying to me because that's the most I would have paid. I didn't want to pay 60. Like, that was the point where I was indifferent. So why would I give the bank, the underwriter, my valuable and good info to help them price a security if I got no benefit? So what usually happens is, as a kickback to me and all the other people that help them price the new security, they set the price lower than what we said all our reserve prices would be, because I then profit. Let's say they set the price at 50. I love that. I'll buy a lot of shares at 50 because I think that the stock is actually worth 60. And I get that because I was willing to actually help them determine the value of the company and what the price of the stock should be. Very important comment here. If the IPO price is set at 50, us, as the normal retail traders, cannot buy the stock at 50. We buy the stock the moment the public market opens, the secondary public market, and then trades happen from trader to trader. So we are trading with the investors who buy Facebook at 50, right? The primary investors who get in on the IPO. But if all of them think it's actually worth 60, well, Facebook's probably not going to trade at 50. And as we see, this is usually the case. The instant trades are actually made in the secondary market, they're much higher than the IPO price. So, yeah, IPOs are usually underpriced compared to what they could be sold at or what they are sold at when secondary trading happens. Hopefully that's not unclear. Now, some are overpriced. There's still a lot of randomness, and there's accuracy errors here. So like running with the Facebook example, when Facebook IPO'd, it actually, after like a week, was down tremendously from what its IPO price was, from the price that the investors on the ground floor, the rich ones that got the primary offering, bought in at. But most stocks are underpriced at the IPO and then kind of surge up a lot because people are really excited about it. Us stupid, ignorant secondary investors just like buy anything new and flashy and fancy that comes out before our very eyes, right? Now, a word of warning. Here is one of the first actual investment or trading tips I will give you. IPOs tend to underperform in the secondary market the first year or two they come out, meaning their return is bad. Their return tends, on average, it's not guaranteed, but just on average, IPOs have a bad 1 to 2 year return compared to the market as a whole. So unless you have very good info and are very good at valuing stocks, you should probably stay away from buying IPOs when they come out. Unless you're one of these ground floor investors, and then that's very different, of course. If you can get the IPO price, then you can dump it on the poor, ignorant investors right when you have the ability to trade when the secondary market starts trading. So think, and this is something we'll hit a bit later, probably next chapter. Think about why being overpriced now means subsequent poor return. Like if when the IPO stock starts trading in the secondary markets today, and it jumps up in price really quick right when trading starts, and it is overpriced today, it probably means over the next year or two, its return or its performance is going to be bad. Think about that. Coming back to this idea of why would a firm stay private or why would a firm go public? And I would love for you to have actually paused and thought about it, but I'll give you at least the reasons I was thinking about. When a firm goes public, they get access to raising capital much more easily. They can issue new shares, and investors will buy it. There's a chance that they can get hundreds of millions of dollars for new shares they issue, depending how popular they are, how well known, how valuable they already are. So it makes it much more easily to raise funds, to raise capital, and to finance the operations that the company has. That should be the main purpose a company would go public. If a company has no need for any money and has plenty of money to finance all of its operations, it doesn't really have a strong reason to go public. Now, why would a company stay private? Because, a couple reasons. When a company is private, it doesn't have near of the hoops to jump through when it comes to making the annual reports. The level of constraints on the company are much lower. You don't have to spend tons and tons of money making sure all your books are perfect and hire very expensive auditing firms to go through all your stuff. You essentially can just do what you want. You have the flexibility to do what you want then. You don't have to worry that, the shareholders in the public markets are going to get mad at you because the price is fluctuating too much and they're going to get new board members in and kick out the management, right? If ownership and management are concentrated, then the owners and managers can just run the company how they see fit and not pay all these costs that public companies have to suffer. There's actually been the trend of delaying public equity offerings, delaying the IPO process. And one reason for that is the private markets have gotten a lot more efficient. So companies have been more able to just stay private and get their funding and financing through private means instead of going public. Okay, let's do a short quiz and then get into the trading stuff. See you guys shortly.